IFRS 15 is an accounting standard. It helps us understand revenue. Revenue is the money a company earns from selling goods or services. This is a fundamental aspect of any business, as it directly impacts profitability and sustainability. IFRS 15 tells us when to recognize revenue. This is crucial because recognizing revenue at the right time ensures that financial statements are accurate and reliable. This means when to record it in our books. Proper timing of revenue recognition can affect a company's reported earnings and financial position. Think of it like this: you sell a product, you get paid. But the question is, when should you officially record that payment as revenue? When should you say you made that money? Should it be when the deal is signed, when the product is delivered, or when the payment is received? IFRS 15 gives us the rules. It provides a comprehensive framework for determining the timing and amount of revenue to be recognized. This standard is important for all businesses. Whether you are a small startup or a large multinational corporation, adhering to IFRS 15 ensures consistency and transparency. It ensures everyone follows the same rules. This uniformity is essential for maintaining trust and integrity in financial reporting. This makes it easier to compare companies. Investors and stakeholders can make more informed decisions when they know that the financial statements are prepared using the same standards. It also helps investors understand a company's financial health. By providing clear guidelines on revenue recognition, IFRS 15 enhances the quality and comparability of financial information, which is vital for investment decisions. IFRS 15 is crucial for transparent financial reporting. It harmonizes revenue recognition practices globally. This allows for better comparability between companies. Investors and stakeholders rely on accurate financial information. IFRS 15 ensures that revenue is recognized fairly. This increases confidence in a company's financial statements. Accurate revenue recognition also impacts a company's internal decision-making. It provides a clear picture of financial performance. This helps management make informed decisions. Franchising is a popular business model. It allows businesses to expand rapidly by leveraging the resources and efforts of independent operators. These operators, known as franchisees, invest their own capital to open and run new locations under the franchisor's established brand. A franchisor grants rights to a franchisee. This agreement typically includes the use of trademarks, business systems, and support services. The franchisee benefits from the franchisor's proven business model and brand recognition. The franchisee can then use the franchisor's brand and system. This means they follow specific guidelines and standards to ensure consistency across all franchise locations, which helps maintain the brand's reputation and customer trust. IFRS 15 plays a key role in franchise accounting. This international financial reporting standard provides guidelines on how to recognize revenue from contracts with customers, which is crucial for both franchisors and franchisees. It helps determine how to account for franchise fees. These fees can include initial franchise fees, ongoing royalties, and other payments made by the franchisee to the franchisor. It also guides the recognition of revenue over the franchise agreement. This ensures that revenue is reported accurately and consistently, reflecting the economic reality of the franchise relationship. For example, a fast food chain grants franchise rights. The franchisee operates the restaurant using the franchisor's menu, recipes, and marketing strategies, providing a familiar experience to customers. The franchisee pays an initial fee. This fee covers the cost of entering the franchise system and gaining access to the franchisor's brand and business model. They also pay ongoing royalties. These royalties are typically a percentage of the franchisee's sales and are paid regularly to the franchisor. IFRS 15 helps determine when to recognize these fees as revenue. This ensures that both franchisors and franchisees have a clear and accurate financial picture, which is essential for making informed business decisions and maintaining financial health. Under IFRS 15, a contract is the basis for revenue recognition. In franchising, the franchise agreement is the contract. This agreement outlines the rights and obligations of both parties. A key step is identifying the performance obligations. These are the promises to transfer goods or services to the franchisee. These obligations can include granting the right to use the brand, providing training and support, and supplying goods or materials. Each performance obligation needs to be accounted for separately. Section 5. Determining the transaction price. The transaction price is the amount the franchisor expects to receive. This is in exchange for transferring the promised goods or services. It includes all fees and payments outlined in the franchise agreement. The transaction price may need to be adjusted over time. This can happen if there are variable considerations. Examples include discounts or rebates. Section 6. Allocating the transaction price. Once the transaction price is determined, it needs to be allocated. This means dividing the price among the performance obligations. The allocation is based on the standalone selling price. This is the price the franchisor would charge for each obligation separately. For example, the initial franchise fee might be allocated to granting the right to use the brand. Ongoing royalties might be allocated to ongoing support services. Section 7. Recognizing revenue. This section is crucial for understanding how and when a business can acknowledge the income it earns. Revenue is recognized when a performance obligation is satisfied. This means that the company has fulfilled its promise to deliver a product or service to the customer. This means the franchisor has transferred control of the promised good or service. Essentially, the customer now has the ability to direct the use of and obtain the benefits from the good or service. The timing of revenue recognition depends on the nature of the obligation. It is important to determine whether the obligation is fulfilled at a single point in time or over a period of time. Some obligations might be satisfied at a point in time, such as delivering a product to a customer. This is often straightforward and can be easily pinpointed, while others might be satisfied over time. For instance, services like consulting or maintenance are typically provided over a duration, requiring revenue to be recognized gradually. For example, the right to use the brand is typically satisfied at the start of the agreement. This means that the revenue from granting the brand usage rights is recognized up front. Ongoing support services are typically satisfied over the term of the agreement. This includes services like customer support, software updates, or any other continuous service, where revenue is recognized over the period the service is provided. Understanding the nuances of revenue recognition is essential for accurate financial reporting. It ensures that the financial statements reflect the true economic activities of the business. Adhering to the correct revenue recognition principles helps in maintaining transparency and trust with stakeholders, including investors, regulators, and customers. Proper revenue recognition practices not only comply with accounting standards, but also provide a clear picture of the company's financial health and performance. By recognizing revenue accurately, businesses can make informed decisions, plan effectively, and achieve sustainable growth. Section 8. Common challenges in applying IFRS 15 to franchising. Applying IFRS 15 to franchising can be complex. Here are some common challenges. Identifying distinct performance obligations. It can be difficult to separate the various components of a franchise agreement. Determining the standalone selling price. Franchisors may not have separate prices for all obligations. Accounting for variable considerations. Franchise agreements often include variable fees or discounts. These challenges require careful consideration and judgment. It's important to seek professional advice when needed. Section 9. Benefits of IFRS 15 compliance. Complying with IFRS 15 offers several significant benefits for franchisors. Improved financial reporting. It provides a more accurate and transparent picture of revenue, ensuring clarity. Enhanced comparability. It allows for easier comparison with other franchisors, fostering better benchmarking. Increased investor confidence. It demonstrates a commitment to high-quality financial reporting and integrity. By embracing IFRS 15, franchisors can strengthen their financial management and stakeholder relationships, leading to long-term success. Section 10 Conclusion: Embracing IFRS 15 for success. IFRS 15 is an essential standard for franchisors. While it presents challenges, the benefits of compliance are significant. By understanding and applying the principles of IFRS 15, franchisors can ensure accurate revenue recognition, enhance transparency, and build stronger stakeholder relationships. What steps can your franchise business take to ensure compliance with IFRS 15 and reap its benefits? Seek professional guidance and invest in robust accounting systems to navigate the complexities of this crucial standard.